Hello everyone, in this video we'll be discussing one of the very important strategies, that is the covered call strategy. Okay, so friends, this strategy will help you to generate additional income from the existing stock holdings or long positions while managing risk. So to implement this strategy, you must be having certain things. The first one is that you must own an underlying asset, and the second one is that you have to sell the call option. Anyway, let's discuss all these things in detail with the help of the PPT. Okay, so friends, as I already told you, you must be having an underlying asset. You should own an underlying asset. It can be stock or index futures contract or anything. Okay, then the second one is that you will be selling a call option. Okay, so you will write a call option against your long positions to collect the premium. Okay, and then the protection mechanism will be like your long position will covers potential losses if the price rises significantly. Okay, then talking about the income generation, you will earn additional income from your existing portfolio holdings. Okay, which means you are earning the premium. Okay, so that's it. Now let's discuss when to implement this powerful strategy. So guys, you will have to analyze certain things before implementing this strategy. So let's look at what are they. Look guys, first one is a market outlook. So because this strategy is best suited for neutral to slightly bullish market conditions. Okay, and guys, if you are aiming to earn premium from sideways price action while holding the underlying, then you can use this strategy. Now talking about the risk, okay, it is limited downside risk, okay, but capped to potential losses in underlying value. Then what about the reward? So the reward will be like it is capped at strike price plus you will be receiving the premium. Okay, so this is the profit that you're going to get. Now let's talk about how to set the covered call. Okay, so there are certain things which you have to keep in mind. The first thing is that identify an asset. Okay, first you have to identify an underlying stock or index that you own or plan to acquire. Then the second one is very important one, that is you have to select a strike price. Okay, while selecting the strike price, you must remember that you have to opt a strike price which is currently which is above the current market price. Okay, so you will select a strike price that is slightly above the current market price, that is you will go for OTM. All right, then next one is that you will sell call option. Okay, so you will write a call option with appropriate expiration date to collect the premium. All right, let's discuss this with the help of some examples. Okay, first let's see this thing. Okay guys, what is the first step I told you? The first step is that you have to identify the asset, right? So here, let's say the asset is the Nifty futures. Okay, and Nifty, let's assume that Nifty futures is currently at this level, 24,500, and you're having 50 quantities of Nifty. Okay, and now what's the next thing? The next step is that you have to select the strike price, right? So this is the 24,500 strike price is at which Nifty was trading. Now you have to select the strike price which is above the current market price, right? So for some reason you assume that Nifty won't go beyond 24,600. Okay, so that you are choosing 24,600 level as the strike price. Okay, so you opted this one. And what's the next one? Next is the premium, right? So let's assume that you're getting the premium like premium of 75 rupee for this 50 quantity. Okay, so 50 is the quantity, right? 50 into 75, you will be getting this much amount of rupee as a premium. Okay, now what's the next thing? Now let's look at two scenarios. The first one is that after expiry, what if Nifty closes below 24,600? Okay, and if Nifty closes below 24,600 strike price, then you will not be selling the contract or you will not be selling the stock, but what will you doing? Then you will not be selling the contract, but you will be getting the premium, okay, the premium of this much. Okay, so you will be having this Nifty with you, okay, Nifty futures with you, and then you will be having the premium as well. Now what is the second scenario? The second scenario is that after the expiry, what if Nifty closes above 24,600? If Nifty closes above 24,600 strike price, then you can sell the contract, okay, as well as you will be getting the premium. Okay, so let's see that you will be getting this 3,750 plus how much quantity you are having? 50, right? This is the level at which you bought this quantity. Okay, this is the level you're going to sell. Okay, so the difference is 100, right? This is 24,500, this is 24,600, so 100. So 50 into 100 is equal to 5,000. Okay, so this 3,750 premium plus this 5,000 is what you are going to get as the profit. All right, let's discuss this in much detail with the help of another example, that is Tesla. Okay, because nowadays I am focusing on US market as well. So let's discuss with this example. First, imagine that you're having 100 shares of Tesla. Okay, and Tesla is currently at 370 level. Okay, and what's the next step? You have to select the strike price. Okay, for some reason you assume that this share, that is this Tesla, okay, this stock does not cross above 380. Okay, so then you're opting 380. So guys, what is the difference? Right? Now let's talk about the premium. Okay, so what's the premium that you're getting? Let's say you're getting $4 as the premium. Okay, so how much stock are you having? You're having 100 stocks. 100 shares. So this much will be the premium that you're going to get. All right, now let's look at two scenarios. And the first scenario is that after the expiry, if Tesla closes below 380, okay, if Tesla closes below 380, then you will be getting the premium. Okay, you will not be selling the stock, but you will be getting the premium. So here you will be getting this 400 plus you will retain the share. Okay, this share of Tesla. Now the second scenario is like after the expiry, if Tesla closes above 380, okay, if Tesla closes above 380, then you will be selling the share, okay, the stock. Then in this case you will be getting the premium plus, see how much quantities you're having? You're having 100 quantities, right? Now what is the difference? This is the difference. Okay, so this much is the profit that you're getting. So the total profit will be this much. So this much profit you will be getting in the second scenario. All right. Now guys, there are some key points that you have to keep in mind. First one is about the income generation. Okay, so if you are using this covered call strategy, you can earn premium in sideways market and reduce cost basis. Okay, and then another thing is that you will use resistance levels to select appropriate strike price. Okay, now what about the flexibility? This strategy is very easy to execute and adjust based on market conditions. Okay, and one thing is that very important, it is profit potential is capped if price rises significantly. All right, I hope this video is helpful to all of you. Thanks for watching. See you in the next video.